Well, hi everyone, and welcome to the Buffett and Beyond ETF report. And this is July 6, 2024. And today we're going over the XLC, which is the Communication ETF. We're also going to go over our top stocks in the QQQs down below. But first, I want to go over the XLC because there's something hidden in here. And is it really as good as they say? Because that's all we've been hearing about lately is the XLC Communication ETF. And is it really as good as they say? We're about to find out. And remember, folks, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And let us look at this XLC and the sector allocation. And here we are in technology. Makes up 48% of that ETF. Consumer services, 29%. Telecommunications, 13%. And consumer goods, 8%. I would think when I knew about this XLC that this was getting into telecommunications, but I guess I was fooled. Now, you don't have the XLC on our computer system, and we just can't get the data for it. The database that supplies our information for the computer program, or some of the information for our computer program, just doesn't have it for us. So this is why we're going over it separately. Now, let's look at these top stocks in this XLC. And folks, we have Meta as number one. I wouldn't think Meta would be in the communications, but then again, when you think about it, yeah, it is. And then they have two Google stocks in there, which are really the same stock. One just has voting rights and the other one doesn't. So they're pretty much one stock. But together they make up 25% of this ETF. And then down here we have Netflix and just above that, T-Mobile. But Netflix is a little bit special because why? Well, when you look at the next slide here, these stocks are all in other portfolios that we have. So the key here is, or the key thinking here is really, do we want to get into the XLC just because it's doing good when we're already in four out of five of the top stocks in other portfolios? We have Meta in all our portfolios, we have Google in all our portfolios, and we have Netflix in most of our portfolios. So let us look at the XLC versus the S&P 500 over 5 years. Black line is the S&P 500. So over 5 years, the XLC falls below the S&P 500. Might as well be in the S&P 500. Now, how about 1 year? Well, yeah, the XLC is outperforming nicely by about 6 or 7 percentage points, the S&P 500, but that's only in the past 1 year. But this is what we've been hearing about. Oh, look how good the XLC has been performing. Okay, let's break it down, folks. Let us look at the tech stocks versus the XLC. So in other words, let's take these stocks that we were talking about, Netflix, the two Google stocks, which are really the same stock, and Meta, and XLC. So again, this is 1 year, black line S&P 500, just above that is XLC, but we have four stocks. It only looks like three because Google and Google are overlapping one another. It's the same stock. So we have 1, 2, and one's overlapping, so that's 3. 4 stocks that are totally outperforming the XLC. So if we already have these stocks, why would we buy the XLC? Why don't we just buy the top stocks in the XLC? Well, we haven't not analyzed all the stocks in the XLC by using the clean surplus method. We are just looking at how they have performed over the past year. This is the past 1 year. Let us look at now, black line is the S&P 500. This is 5 years. This is Google. This is Meta down here, the blue line. And then down here we have Netflix. But Netflix has done better over the past 1 year. But down here it is just about performing as well as the S&P 500 over 5 years. So we are now looking at, and of course, XLC right down here. Let us look at the other stocks other than the to Google stocks, Meta, and Netflix. Let's look at the rest of these. We have Charter, we have Verizon, Electronic Arts, T-Mobile, T by AT&T, and XLC. So the only stock outperforming the S&P 500 out of the other stocks is T-Mobile. And boy, that's doing pretty good, isn't it? So there's T-Mobile there. And Blackline. So in other words, what we're saying is that the stocks that we already have in other portfolios, either our 30 stock growth portfolio or our sector all-stars or our QQQs, we have all those other stocks. Why buy the XLC if we're going to duplicate those other stocks? Because the other stocks in the XLC are all, with the exception of T-Mobile, all underperforming the S&P 500 by averaging about 20% versus 80% for the S&P. That's a long way away, folks. So why in the world would you buy the XLC and put all these underperforming stocks in your portfolio when it's really Google, Meta, Netflix, and in this case T-Mobile, which are outperforming the XLC or the S&P 500 by a long ways. Now, would I run out and buy T-Mobile? Well, I'd have to look at it, or we would have to look at it on the computer program and see what it does. And I just want to show you that we took Tesla out of all the portfolios except the QQQ top 11 or 12 stocks. And this was Tesla as of last week, and we can see that it was starting to move up after just staying here for a while, after dropping quite a bit, and then all of a sudden come ripping back, and then settled into a couple of months of sideways action, and then last week just started taking off. This was the 200-day moving average, this red line, remember? Well, we took it out of all our portfolios except the QQQ portfolio, because number one, the QQQ portfolio, our QQQ top stocks, is my favorite, my personal favorite ETF. Why? Because I do covered option writing on some of my stocks when I need cash, and those stocks that are in the top QQQs, well, we're going to go there in a second. So those top stocks have really, really good option premiums on them. So that's what I do in my personal account. The QQQs is my favorite portfolio. But let's look at Tesla, since we left it in the QQQ. It's the only portfolio that we left Tesla in. And this week, wow, it shot up above that 200-day moving average, and it's still going up. And we're thinking about taking it out because we are still talking about a car company. Yeah, technically orientated car company, but when you start looking at the other car companies that are coming out with the electric vehicles, then Tesla becomes a little bit more than another car company. But we've looked at Tesla a couple of weeks ago. I think it was in one of our daily letters, and we looked at it. We just saw that clean surplus ROE dropping like a rock. That's why we're taking Tesla out, not because we're thinking about the stock and thinking that it's just a car company, but it fell short on sales, and you have a Chinese electric vehicle company that's out now, and it's in competition in China with Tesla. And so anyway, the clean surplus ROE fell on Tesla, and so we're even taking it out of the QQQs. I don't know if I'm going to do it before this day is over, because I'm recording this on Friday after the 4th, Friday the 5th. Yes, it usually comes after 4 is 5. And we are probably taking this out of the portfolio before the end of the day or Monday. And that'll be it for Tesla for us in any of the portfolios. So let's look at some of these QQQs with hedging. And we can see that now the top stocks in the QQQs are up 40%. Okay, 39.9%. Now, if you're timing your hedging, and we have hedges on right now, and they're going against us, but we've lost about 10% in the hedges. But here, since it represents about 30% of the portfolio. We're down about 3% there. So if we're timing our hedges, we're up 35.6%. If we're hedged all the time, we're still up almost 23% versus the S&P of 16%. So you could be hedged all the time about 30% on the portfolio and still be up 23%. So this is, now you can see why I like this portfolio, because some of these stocks are doing very, very well, good option premiums on them. And of course, really my whole theory in investing is to buy the stocks and leave them alone. But every now and then you need some cash, and these are some pretty good stocks to sell covered calls on. So folks, we've had a pretty good week. The end of the month, beginning of the month, upward bias of the market is past us, and the market did go up. And then the 4th of July, we had our holiday coming in, which is usually an upward bias for the market, and it did exactly what it was supposed to do. Now we'll see what happens this coming week, whether we take the hedges off, the ones that we're timing anyway, or we leave them on. We're doing pretty good with the hedges without having to take them off if we don't know what the market's going to do. But we reached new highs on the S&P 500, and now this coming week we're going to have to see if that area holds. If it holds, then we'll take the hedges off. Those of you who are timing hedges, most of you have hedges on and you just leave it alone. So we're doing pretty well there, folks. Anyway, you go out, you enjoy this weekend, enjoy the rest of the 4th of July, very long weekend. And folks, be with your loved ones and stay safe, and we'll see you back here in a few days.